Hello, this is Ryan Mahoney, Associate Advisor here at Cypress Asset Management, and I want to welcome you back for our Quarterly Perspectives third quarter 2022. This presentation details quarterly equity and fixed income performance along the framework of absolute returns, relative returns, and future expectations for market performance. We will then go on to discuss recent interest rate movements and inflation expectations. Lastly, we will examine how different asset classes contributed to an overall portfolio return. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S., developed international, and emerging market stocks were all down for the quarter. Quarterly returns for U.S. and global bonds were also negative. Next, I'll draw your attention to the upper right-hand portion of this graphic. The U.S. dollar was up 7.1% for the quarter and up 19% over the last 12 months. Now let's take a little deeper look at what was driving the returns of both stocks and bonds. We will start by taking a look at how global equities performed for the quarter, and we'll isolate the performance between U.S. and developed international stocks. The two charts here show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell Indexes, and international market returns are measured with the MSCI World ex-US Index Series, which represents global developed market performance excluding the U.S. As we can see from the dark blue line on the chart on the left, the U.S. market was down 4.5% in the third quarter compared to down 9.2% for developed international markets on the chart on the right. Bucking the trend from the previous quarter, global developed markets favored growth stocks over value stocks during the third quarter, and contrary to last quarter, the U.S. beat out its international counterparts on a relative basis. However, markets were down overall, with international large value stocks suffering the worst losses, as seen on the charts above. But no matter the recent trends, it's important to remember that we should not be making long-term projections based on short-term performance. Now we take a longer view to see how different investment styles have performed for standard periods ending September 30, 2022. Looking at annualized returns in the U.S., we can see that it's been a challenging time in all areas of the market, particularly for growth-oriented stocks for the 1 year, as the recent performances face significant headwinds such as ongoing fears of recession, continued geopolitical uncertainty with the war in Ukraine, and now a firmly hawkish Federal Reserve that has stated that the fight against inflation will likely not be painless. All of this taken together has manifested itself in heightened economic uncertainty and market volatility. Large value stocks had the smallest decline for the trailing 1 year period, losing 11.4%, but beat the U.S. market by 6.2%. We also see that small value has underperformed most other investment styles at horizons displayed on this chart. Consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for our clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer horizons. It's important to recognize, however, that despite the relative underperformance, small value has still returned a formidable 7.9% per year in the U.S. for the last 10 years. Turning now to international markets, we see that large cap value stocks have led the pack over the 1 year period, albeit at a lower total return compared to the U.S. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering the highest returns over the 10-year period at 4.8% and 4.9% respectively. Relating to the prior slides, we see that international markets have underperformed the U.S. market at every horizon, with the 3-year performance trailing by 8.9% per year, and the 5 and 10-year performance trailing by 9.1% and 7.6% per year, respectively. Given the higher U.S. return, we expect portfolios concentrated in U.S. stocks to have outperformed a globally diversified portfolio. However, as we'll see in the next slide, these relative performance numbers are not reason enough to abandon international stocks completely. Thus far, we've discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market evaluations and how they relate to future expectations in market performance. The charts on this slide show how expensive stocks are by measuring the price-to-earnings ratio, a very common metric used to value equities. The higher the ratio is, the more expensive the asset class is overall. Or thought in another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total U.S. stock market costs roughly $19. Internationally, as we can see in the chart at the top right, earnings are cheaper at less than $13 per dollar of earnings on average. These values represented here use historical fund and ETF data to establish the price ratios, and the average PE ratio is reflected by the dotted line on the chart. These averages start at the first quarter of 2004 for U.S. measures and in the fourth quarter of 2006 for international stocks. So the average is roughly 19 years in the U.S. and 16 years internationally. In addition to identifying relatively cheap segments of equity markets, these ratios also help set the table in forming expectations about the future. Although we like to say our crystal ball is forever cloudy, there tends to be an inverse relationship between current equity valuations and future performance. In general, investors will bid up the price of certain stocks in the expectation of higher future earnings. Therefore, as a particular group of stocks becomes more expensive, their expectations of future earnings growth are lessened because investors are less willing to pay an ever-growing premium for those expected earnings, especially when future earnings can be bought elsewhere for less. Put more plainly, the more expensive that stocks become in relation to their earnings, the lower their future performance expectations become. I'll emphasize that this is a long-term relationship, and as we've already seen on previous slides, there's a wide range of possible short-term outcomes. Here we have the same analysis but isolating U.S. equities so that we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year run. We can see that growth in price has exceeded the growth in earnings as the PE ratio has climbed to 26.2 to close the quarter, which even after a challenging performance over the last 12 months is above its average of the last 19 years. Small value, on the other hand, even with the rebound of value stocks relative to growth stocks during the last 2 years, still has a PE ratio under 10 and under the average over the last 19 years. Although many investors may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we'll take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing in inflation. The charts here show the average performance of different bond maturities in the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter in maturity and higher quality compared to the broader market. And the chart on the left, we see that bonds of all maturity ranges had negative performance, but markets favored the short to intermediate maturities relative to longer dated bonds. It's worth noting that the extreme fluctuations that we tend to see in the 10 to 20-year bonds are why we like to keep our maturities short to intermediate. The chart on the right shows the performance of different intermediate maturity credit quality bonds. We see again that all bonds in the credit qualities listed were down for the quarter, with investors favoring municipal debt relative to other government and corporate debt. Next, let's take a look at the Treasury yield curve and what it means for returns going forward. Here we've plotted the yield curve to show the current yields for Treasury bond investments at different maturities. The bright blue line represents current rates, the gold line rates at the end of 2021, and the dark blue line represents rates from 1 year ago. In short, the early part of the curve is both steeper and is elevated overall compared to the end of last year and to 1 year ago. Practically, this means that expected returns on fixed income are now higher, but that Treasury returns would have been negative for the quarter and over the 1 year periods. More notably, the majority of the yield pickup this quarter has been on the shorter side of the curve, so much so that the yield curve has inverted. And when this happens, particularly between the 2-year and the 10-year points on the curve, it is widely regarded as one of the precursors, but not as a guarantee, to an impending recession. Finally, we have plotted the market's forecast for inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations. The gold line represents inflation expectations at the end of last year, and the dark blue line represents inflation expectations from 1 year ago. Consistent with what we have been reading and hearing in the media, the Federal Reserve's aggressive rate hike campaign has led markets to lower current estimations for future inflation compared to the beginning of the year and this time last year. As these expectations continue to change, it's important to remember that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of 2.1% per year for the next 5 years, and the market collectively expects inflation to slightly outpace the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices, but they're also baked into equity prices. Making a bet on higher inflation would mean that we expect inflation to exceed the current forecast. Next, let's take a look at how some major asset classes contributed to a 60-40 index mix this quarter and how that index mix behaved during recent history. On this slide, we look at the absolute impact of different asset class returns on the quarterly return of a sample 60% stock and 40% bond index mix. With both stock and bond markets declining this quarter, we can see that all asset classes contributed to the overall decline of the index mix. U.S. large cap stocks were the largest detractors for the quarter, while U.S. small cap value stocks were the smallest. And even though returns were negative, it is important to maintain a diversified portfolio like the index mix shown here. Bonds, while down this quarter, ultimately served their role in mitigating stock market risks. Diversifying stock holdings across countries and factors of return helped mitigate the strongest losses this quarter that came from U.S. growth-oriented stocks. Now here we see a collection of major asset class counter-year returns arranged on a quilt chart. Looking at year-to-date returns in the rightmost column, we see that almost all asset classes posted negative performance, with real estate losing the most value, down 29.3%. Cash was the only asset class that posted a positive year-to-date performance with 0.6%. A diversified index mix, such as the 60% stock and 40% bond mix, as shown in the white tile, tends to stay away from the extreme returns, both positive and negative, on a yearly basis and over time, while also dampening the volatility of returns. This is an example of the potential benefits of a well-diversified portfolio. It also helps us as investors to stay in our seats through any given quarter of market turbulence and not to take away from our ability to prosper from the many quarters to come. And with that, we have reached the conclusion of today's presentation. Thanks yet again for joining us, and as always, we will see you next quarter.